So hello everyone. Thank you very much for joining us and welcome to part 2 of our fundraising webinar series. Today we're going to be joined by Leonardo from Uncapped. Leonardo is going to be giving us an insight into revenue-based finance. It's a great way to secure funding for your business without having to dilute your equity. But before we start, for those of you that don't know who we are, my name is Sophie Skula. I am from Claim Capital. We are a market-leading R&D tax credit specialist that helps startups and scale-ups claim up to 33% of their R&D costs. I'd also like to give a quick shout out to our 2 sponsors, which are subdivisions of Claim Capital. First of all, we have Jump Accounting. They offer all your accounting needs to help you build, grow and scale your business. And secondly, we have Granted. Whether you're looking for successful template, guidance or a fully written grant application by one of our grant writers, Granted has all the tools you need to help you write a successful application. Now, as a full service, we understand that R&D tax credits and grant funding alone aren't enough to help you grow your business. Therefore, we are hosting a series of these events to ensure that we can give you a full understanding of the different funding options available to you. So without further ado, I'd like to hand over to Leonardo, who's going to be talking to us about revenue-based finance and about Uncapped.
Great stuff, thank you. Hey everyone, thank you for having me today. To give you some background about what we'll go through today, we are basically going to get a little insight into the funding landscape for online businesses, basically what the options are out there that are available, how to take advantage of these options, and what other funders like you are doing to ensure growth. Of course, we'll also look at revenue-based finance, that, as Sophie mentioned, is what Uncapped specializes in. This is quite a relatively new, friendly funding model, which we have adopted a couple of years back. And we believe at the moment is the cheapest, most flexible way to fund your business, so hopefully extra relevant. But by way of background, if we could go to the next slide, please. Again, I'm Leonardo. I look after partnerships at Uncapped, and as I mentioned, RBF is what we do, and actually we're Europe's #1 provider and currently its largest e-commerce investor. What that means is that we basically believe that funders shouldn't give away equity or dilute ownership in any way in order to fund growth. And that's why we provide between 10K up to 5 million in investments free of equity, interest or personal guarantees. What we do charge is just a 6% flat fee on the capital provided, and we get paid back by a way of revenue share. So for example, 10% share on revenues until the full amount has been paid back. So what that entails is that there's no pitching, no business plans, no coffees with investors required for 6 months, which means that you can literally go back to what you're here for, which is growing your business. So we'll go through a bunch of funding options today, but if we could go to the next slides, we'll focus for a very short period on what makes RBF special. So first of all, we're very fast, meaning that you can apply within minutes and get an answer in 24 hours. You can retain control of your business. As I mentioned, there's no putting up the house to as a guarantee or as a security for the loan. There's no equity involved, meaning that it's your business and you should retain control of it. And finally, we stay very, very flexible. So if revenue is low down, thanks to our revenue share model, so will your repayments, which means that you're not stuck with higher repayments if you have a bad month and your cash flow isn't under strain. If we go to the next slide, we can look at, some of the brands that we've helped. Again, very, very focused on tech and direct to consumer and e-commerce. So again, hopefully this all applies to you. At the moment, we are in 13 countries, UK, Poland, Germany, all over Europe really, and in the US too. And we're on track to deploy around 500 million across all of these geographies. So hey, if you have any questions or anything at all, you can just shoot me a message on LinkedIn. I'll see how I can help. But for now, let's get into it. So yeah, so before diving deep into the model and explaining all the nooks and crannies of it, I personally think that the best way to explain how RBF works is through our founder stories. If you think about Uncapped, we're only a couple of years old, but the achievements and the milestones that some of our founders have been able to get to in this very short time period are nothing short of astonishing. So we thought we'd go through 3 examples. We can probably take those questions at the end, so no problem. But yeah, 3 examples starting from Alex and Anna from Edoin. So I'm not sure who's familiar with Edoin. They're an amazing business, a women-founded business, and they do women's wear for kind of a high-flying, independent women. And they're very casual, but also adaptable for the workplace. Incredible brand. And like any e-commerce business, the Black Friday, Christmas period is key for them. And they were actually one of our earliest clients back in 2019, 2020. Christmas was coming up and they needed, some quick source of funding to push their Instagram and Facebook ads. And so we had a chat with them and we ended up investing 50,000 into the business as a first tranche towards the tail end of Q4. What that meant was that they poured everything into their Instagram and Facebook ads. And that led to this incredible revenue growth the next month of 1,106%, which is, again, just crazy. But the beauty of the story is not actually the crazy growth, it's what happened afterwards. As we all know, after Christmas 2020, we had February 2020 with the start of the pandemic. And although the pandemic was bliss for most e-commerce businesses, we had those first couple of months where revenues slowed down across the board because everyone was so unsure and so wasn't really spending cash online really. And the same happened to Alex at Hedoin. And so what happened was that their revenues dipped massively. But again, thanks to the rev share model, they weren't stuck with high repayments and they were able to pay back in their own time. And so we're very happy to still fund them today. And as you can see, on top of that initial 50K, we invested a further 100,000 in 2 or 3 different tranches, which is, again, still helping them today a couple of years later. Onto the next slide, actually, we have a pretty similar but still different business, The Stem. Again, if you're based in London, massively recommend these guys. They're an online plan delivery business. James, incredibly financially savvy founder. He comes from an investment banking background, and if anyone has ever worked in the industry, it can be quite taxing on the mind and the body. So he decided to go back to what made him feel at home, which is nature. And so he started The Stem, and like a lot of e-commerce entrepreneur, he scaled the business bootstrapping it. However, you get to a point where you cannot grow it further unless you go external finance, right? It's the classic chicken and the egg problem where you either spend a lot of cash on customer acquisition and marketing, but then you probably have a gap in terms of acquiring stock and keeping up with demand, or you secure a lot of stock, but then you've got another gap in your cash flow to actually go and acquire customers and invest into Facebook, Google, Instagram advertising, etc. So that was exactly his issue. And so usually at that point, that's where external finance starts to come into play. But the idea of a VC round was, let's say, daunting for James, especially because of the time involved. And so long story short, we had a chat with him. We invested £50,000 in the business that he poured into marketing and stock purchases. And this business, again, boomed. 300% revenue growth, as you can see from the slide, and around 500% in ROI. So whilst Alex was more about a one-off seasonal investment into the business to make sure that they grasp growth opportunities during certain times of the year, this is more about actually the next step in the scaling journey of The Stem. And even more towards that side of the spectrum is Oliver from Marshmallow in the next slide. So this very different business from the first 2. Again, I'm not sure who's familiar with Marshmallow. They're a car insurance company online. And what they do is, your classic tech VC-backed business. So again, very different from the bootstrap models we've seen before. However, they still were interested in having a chat with us because they were going through a big race, and they were like, well, out of those 5,750,000 of that is going to go towards Google and Facebook advertising. So is it not cheaper to pay 6% on that 750 rather than give away a chunk of my company? And this is a conversation we have with founders, every day, and it's a very smart thing to do, right? You can, equity is one of the most expensive ways to fund pure growth, but at the same time, I believe that between 42 to 45% of all VC funding goes to Facebook and Google, which puts things into perspective. So that's exactly the plan that we executed with Marshmallow. We funded them the 750K. They grew and they managed to close that round at a pretty good valuation. And they calculated afterwards that they saved up 7.5 million in dilution just by doing this. This is extremely more relevant now because only a few weeks back, Marshmallow became a unicorn. And so one of their VCs that led the round was like, well, hey guys, how did you actually manage to keep so much in terms of equity and ownership? And the answer was revenue-based finance and Uncapped, which of course makes us very proud. But yeah, again, to wrap up, there are three very different examples of three very different founders, but they all found in revenue-based finance a perfect way to continue their growth history. So now that we've looked at how it practically works, we wanted to show you, why actually was this so special for us? Why is this model so interesting? So if you can go on to the next slide, we're ready to find out and understand what's actually out there. But before we look at the different options, we talk to direct-to-consumer founders, online business founders, and investors every single day. So we thought we'd begin with a few stats and insights that we wanted to share. So first of all, as everyone knows probably here, there is a massive uptick in direct-to-consumer companies that are actually raising external finance. And this comes to no surprise because e-commerce businesses are actually seeing valuations that were back in the day only reserved for SaaS type or like tech businesses. We're seeing multipliers from our investors for purely e-commerce and consumer businesses at around 12x, which is very interesting. Also, brands are exploring alternative sources of capital, which means that they're getting more and more wise regarding what type of capital is correct at different stages of their growth. And this, of course, is turning away slightly from the concept that the only external finance that you can get is VC multi-stage massive venture funds that are looking for these big unicorns. And on the back of this, actually, before 2020, it was very hard to see a lot of e-commerce businesses be venture backed. However, through the pandemic, as we've mentioned, we've seen basically 10 years of growth within only 1 year. And this is a trend that we believe is going to continue, which is then leading to these incredible numbers and incredible performance. However, we do notice quite a bit of skepticism and scrutiny from investors on whether this growth is actually sustainable. And we don't think this is, focused on businesses that have healthy unit economics and actually, have a good plan for growth and a good roadmap to profitability. This is more for the businesses that use the promise of a big exit at some time in the future as a way to stir away attention from their poor unit economics. But in terms of what the options available actually are, and starting from VC funding, if you could go to the next slide, please. This actually is a chart that I love because it perfectly shows the ecosystem and the access to venture capital for e-commerce founders. So the big blue circle is actually the whole ecosystem. And as you can see, the majority of it will not have access to VC funding. The blue small dot at the bottom is the companies within the ecosystem that do access venture capital, but do not reach venture scale. Whilst the red button is the companies that reach 1 billion plus valuations, meaning they become a unicorn. And the reason why you can't see it is that it's so small that it only takes it not even takes a pixel. So I guess that puts things into perspective in terms of how much inequity there is in equity. If we compare this with the fact that only 0.05% of founders actually access venture capital, and most of these guys are actually men. Again, it puts a lot of perspective in terms of VC funding as a source of capital. But of course, there are loads of other options. So why don't we look at some more accessible ones? So this is another quite neat visual. So we've talked about VC funding. Why don't we talk about that? You know, and why not? Because bank loans at the moment are some of the lowest interest rates that there have ever been. So it would make sense for someone to consider that at the moment through a bank. But the truth is that, of course, you need some very strong track record to apply for a loan. So, you know, even Funding Circle expects at least a couple of years of trading history before considering the business. And of course, there's the issue of personal guarantees, right? If you're a first-time entrepreneur, you probably don't even have a house to pledge. So this becomes a problem. Going back to VCs, you know, actually, I don't want anyone to come out of this and think that we're antagonizing VC funding. We're a VC funded business ourselves. We partner up with 300 plus VCs who love working with us because, of course, we can provide more capital to their portfolio without diluting neither the founder, neither them. But at the same time, you know, what the truth of the matter is that although there are businesses like, for example, Marshmallow that see value in using both in tandem, there is a lot of inequity in equity, and at the end of the day, around 15%. The vast majority of founders ends up with less than 15% of ownership of the company at exit at the moment. So that's definitely something to take into account when starting to go through that route. When it comes to other equity-based options, we've got crowdfunding, of course, which is, you know, I'm a big proponent of. I think it's very smart if it's done as a marketing play. So it's a great way to acquire early customers. And, you know, you can actually raise a lot of capital there as well. At the same time, it is a long, nerve-wracking preparation process. And that's because aside from preparing the actual campaign, there is the understanding that if you do not meet your crowdfunding target, that can negatively impact future conversations with investors or other crowdfunding companies, which again can really put a brake onto your growth plans. So ultimately, revenue-based finance is just our founders going through the machine and kind of trying out every single one of these options and creating a tool that didn't exist when they were creating a business and that they would have liked. Right. So if we go to the next slide, we can see actually how it all stacks up by stage with, you know, bootstrapped businesses or family and friends or angel backed businesses, then going into revenue-based financing using a mix of RBF and venture capital to fuel growth until they reach the stage where they can finally get some cheaper debt and hopefully exit. And the beauty of this is that RBF is becoming more and more an established way to support the business. And we're backing the sentiment up, if we go to the next slide, with some of our own portfolio data. So we've noticed that year on year, we've experienced a 27% increase in the average ticket size, which means that if at the beginning of our journey, people came to us just to fix gaps in their cash flow, now more and more founders are seeing this as a way to actually sustain growth from start to finish. So with this, actually, we'll open up for some questions. But hey, the thing is that raising capital has been historically a daunting process for founders, and it can take months and it can be quite expensive for the entrepreneur. But the good news is that funding is, you know, an ever-evolving process. So hopefully this gave a little insight into what's happening, what's out there, and the key learning, I guess, here is that there's not one way to fund your business. There are multiple, and neither one of these is perfect. It simply depends on at what stage the business is and what the priorities are. Is it speed? Is it cheap capital? Is it dilution? The opportunity cost of going, for example, through us, it can be not having some value add investors to say on your board, for example. But if that's not what you need, you just simply need working capital and growth capital. RBF can be a great option. So again, would love to hear your questions, if any, and if you have any other messages, if you need to shoot off, you can just send me a message on LinkedIn.
No, thank you so much for going through that, Leonardo. And I think it's really good to see some case studies to kind of see how the revenue-based finance has actually helped businesses. And it still blows my mind that it saved Marshmallow £7.5 million in equity. So thank you so much for going through that. I do believe we have had a question on the chat in regards to the terms and conditions of Uncapped. So it kind of ties into one of the questions I had in terms of, can we kind of maybe go over the criteria that you look for when engaging with a company?
Of course. Yeah, no, sounds great. And I also received a direct message from Amin regarding, do you run a personal credit check? So I'll answer that first because it's very quick. So that's not part of our underwriting process as such. So we would usually connect to these guys' accounts, so their Shopify, their Amazon, Stripe, any source of online data, really. We process that data through a revenue predicting engine, and that already gives us some sort of yes or no answer. However, we do have a credit committee that meets, 3 to 4 times per day, let's say, and they will have the final seal of approval. And part of that process is, of course, running some KYC and some credit checks. But the bulk of the decision making is done purely based on the performance of the business. So hopefully that answers your question. Of
Thank
course.
you.
Sorry, Harry, to go back onto TNCs. Let me go through how it works. So basically, we invest in these businesses without asking for any equity interest or personal guarantees. And there is just a flat fee that's charged of around 6% on the capital, and we get paid back by a way of revenue share. So usually when you're presented an offer, you would have 3 different options for capital. So say, for example, 100, 150K, up to 200K. And then it's pretty flexible in terms of how much revenue you're comfortable sharing. And that, of course, will impact the size of the loan. But there's no fixed repayment terms, meaning that it's not like a 6 or 12-month loan. The rev share allows you to pay back in your own time. And again, it's unsecured, so there's no personal guarantees, no warranties or anything like that.
Okay, great. And I believe is there some more questions in the chat?
Yeah, perfect. Should I just go for it? So,
yeah.
Thanks for your presentation. Do you guys offer rev-based financing for B2B enterprise SaaS businesses as well? Yes, we do. So SaaS is actually a big part of what we do at the moment, and a larger part of our portfolio, which has been historically e-commerce, is now SaaS and tech. And we have different products as well for tech businesses. I can provide more information after this, maybe offline, but basically RBF is one model. The other main model for SaaS businesses is called a fixed term product. What this does is instead of taking a rev share and having like a flexible timing, we have a fixed term of around 12 to 15 months. To give you some context, the average e-commerce pays back within 6 months. So this is longer term, 12 to 15 months, and we wouldn't get paid via rev share. We would just charge a flat fee, amortized monthly. And so what that means is that businesses like SaaS, we would give all the cash up front, because these guys, work with MRR and subscription type models. And so we would give all the cash up front, and as the revenue grows, that fee would be relatively smaller and smaller as the months go by. So that's something that's worked very, very well with SaaS, and we've been able to work with the likes of, Cord, Amba, some other amazing businesses in that space. And regarding the size of the business, you mentioned enterprise, we can provide anything from 10K up to 5 million. So usually, to give you an idea, we would invest 1 to 1.5x last month's revenue, maybe more if there are some good conditions. For SaaS businesses, we can go up to 2 or 3x, depending on the contracts and some other details. The beauty of this actually is that, you know, this is a very much a data-driven model, but we always make a point to have conversations with clients. So there's usually a 30-45-minute call with our investment team to deep dive into the specific needs of the founder and the business. So there's probably a conversation to have with them. Cool. So Andret asks, Leonardo, do you finance projects that are going to operate abroad? Yes. So the only thing that we look at is where the business is located, because that will basically dictate the regulations under which the business operates. But to give you an idea, we can operate across most of Europe, with the exception of Italy, where I'm from, with like the amount of rules in that country are insane, and France, but the rest of Europe is fine. So UK, Spain, Portugal, Germany, Poland, you name it. And we also operate in the US. But to give you an idea, if it's, for example, a UK business operating in South America or in Asia, that's totally fine. Elena asks, how soon does a company have to be for revenue generation for this sort of funding? I ask as we are a health tech company and timelines are usually longer. Sorry if this was covered already. How soon does a company have to be? So I'm guessing what kind of track record do we need? What minimum track record do we need in order to underwrite a business? That would usually be 6 months of trading and the minimum of 10K monthly revenues. So it's pretty early stage. I guess the sweet spot for us is a business that's gone out and proved their economics, and now is kind of looking to put their foot on the gas really and accelerate growth. But yes, 6 months trading and 10K as a minimum before we can take a look. Ari, yes, 6%. Oops, sorry.
No, go. I was just going to read a question. No, you go for it.
No problem. So I saw something on that comparison table that mentioned high variable rates. Can we maybe go back to that slide, Sophie, so that we've got the visual?
Oh, absolutely.
Thank you. So yes, so in terms of, sorry if that's misleading, that actually says high variable payment. So what that means is that the 6% will stay flat and fixed throughout the duration of the contract. However, the payments are flexible because they're based on a percentage of revenue. So again, at the offer stage, you would select the fees and the rev share you're comfortable with. And as soon as you select that rev share, for example, 10% of your revenue, that also will stay fixed for the duration of the agreement. And so, for example, if it's an e-com business taking out 100K, we would they would basically owe us back 106,000, and at 10%, that's 10% of the revenue until they've paid back everything in full. And that percent would stay fixed. The revenues can go up, they can go down. We don't care. It's just about having this flexible repayment structure. Cool. And then I guess it's the last question. Are there sectors you won't work with? That's a good question. Unfortunately, we can't work with gambling, porn, guns. We can work with adult toys, however, and CBD we can work with, although it is like an ad hoc type conversation. And that's not really because it's, these are perfectly fine legal businesses. It's more about their performance. Some of these businesses have exploded, but they've had to go more towards kind of offline routes, because advertising online for CBD is just insane at the moment. But hopefully that gets better with time. Do you invoice us, the company, monthly? So that also depends. At the offer stage, you'll choose whether you're happy with monthly, weekly, sometimes daily repayments. And the payments are ideally done by DD. This is done by open banking.
Okay, amazing. I think that ties up all of the questions. I suppose all that's left to say really is thank you very much for coming along, Leonardo, and talking us through revenue-based finance. I'm sure if anyone's got any questions, please feel free to reach out to Leonardo. And all that's left for me to say is I'd like to take this opportunity just to announce our next webinar that's taking place next month. This will be the part.
If I can say one thing before you go for it, if you don't mind. Guys, thank you so much again for having me and for bearing through this. I couldn't hear myself for 42 minutes, so as a little reward, I'm sure Sophie will follow up on this. But we're actually offering a 50K for free for anyone who is interested for the month of November only, and this is an exclusive for Klein Capital and their network. So if you're interested, just shoot Sophie an email or myself on LinkedIn or via email, and yeah, we'll make it happen. But thanks again. Sorry to interrupt, Sophie.
No, not at all. And thank you very much. I'm sure everyone would agree that's a really, really good offer and not one to be missed. So yes, all that's left to do is just kind of announce the next webinar, which will be part 3 of the series. This will be taking place, yes, as I said, next month. We've actually partnered with Crowdcube, the UK's largest crowdfunding platform. And what they'll be doing is taking us through how you can achieve a successful crowdfunding campaign. So it's not one to be missed, and the link to register will be